We want you to plan for success. Welcome to Planning Matters Radio.
Hi, Peter. Good to see you. Today we have a great question. Are annuities a good investment? As stocks struggle, sales of annuities reached record highs in the second quarter of 2022. It was actually $77.5 billion. That's the highest quarterly sales ever recorded. So we've talked a lot about creating stable income in retirement. And I just want to start with fixed rate annuities. What are they?
Well, so backing up a little bit, want to just address are they a good or bad investment? Yes, they are. Both, right? There is no perfect financial vehicle, and there's not one that is always categorically wrong or evil. Now, what we need to understand about annuities is that is a very general description of a type of instrument offered by an insurance company. And there are savings vehicle versions of annuities, and then there are investment version vehicles of annuities. Savings is safe. It indicates that there is no risk involved, whereas investment has the acceptance of some amount of risk to our principal deposit. So a fixed annuity is a savings vehicle. It's akin to like a CD type of instrument where there is a period of time that you are dedicating your money for a fixed interest rate that you receive while the money is deposited during that term. And I do think that these have some distinct advantages and places where they could be appropriately utilized. And then there's also money that absolutely this is not the right place for a fixed rate annuity. One, if you need immediate accessibility to your money, an annuity is almost never the right place for that money. So like your emergency account or money that you intend to use for a short-term type of purchase. On the other hand, if you expect market-based returns, like you're shooting for higher rates of return with the potential growth of the market, a fixed rate annuity is also probably not right. But if you'd like some long-term growth without risk of loss of principal on money that you know you're not going to need for a specific period of time, fixed annuities do offer higher rates than similar term instruments in a lot of other places like banks or even bonds, for example.
Okay. So we've talked about then the fixed rate. And so I just want to bring up this visual because I find it very helpful as we talk about the scale of risk by annuity type. We can see fixed annuities on the left there. So now tell me, variable annuities, Peter, what are they?
So those are on the investment side of the spectrum.
Okay.
Again, I think that there's a lot of complexity with annuities because there are so many different types. And that's one of the reasons why people tend to shy away from them is I hear, well, annuities are so complex. Yes, if you categorize all of them into one description, they are because they do so many different things. But variable annuities are investments. In essence, they are mutual funds. They're called sub-accounts, but they're mutual funds wrapped inside of an insurance wrapper. The problem that I have with variable annuities is that a lot of times people walk into their the back room at the bank or the broker's office and say, I want to keep some of my investment money safe. And then they end up walking out with a variable annuity, which the principal value is still going to be invested at risk. It can go up or down with the market. And then the safe quality is that they're paying some additional level of fees to put an insurance on the variable annuity that protects against loss of value in the market for a death benefit or gives some type of guarantee for that value for future retirement income. But the principal value, the core investment dollars are still at risk. And oftentimes, because of those protections, there's additional higher levels of fees. So not only is the principal not safe, but oftentimes they're coming back and I'm seeing variable annuities with fees of 3.5%, or even 4% or more.
Wow. Wow. Okay. So in the middle of that risk spectrum and kind of the third type that a lot of us are familiar with, indexed annuities, what are they?
So indexed annuities are either, depending on who you listen to, always evil and always to be avoided, or the absolute best thing since sliced bread.
Well, that helps clear things up.
Going back to my original statement, Erin, neither is categorically true. Now, index annuity is a vehicle that is on the savings end of the spectrum. Your core principal investment is protected against market losses. You are not invested directly in the market, but the insurance companies have different allocations that you can choose from within the indexed annuity that allow you to use the market as a metric for sharing in the gains. Now, because there's no risk, they don't give you a very generous portion of the gains, but it is a savings vehicle protected against losses with the ability to have a little bit more upside growth potential in good market years or when the index does well within a specific period of time. And so compared to fixed rate annuities, there's not the certainty of a guaranteed interest rate. But over time, over a period of 3 to 5 to 10 years, most often the share in the gains of the market does better than a flat fixed interest rate. But also, compared to variable annuities, these index annuities do not carry the risk of you actually losing value if there's a market downturn.
Okay, thank you. That does help make sense of it all. So, would you recommend then that risk averse investors allocate a portion of their bond portfolio to annuities?
So there have actually been a lot of studies on this
Yeah.
in the past couple years. Roger Ibbotson is a pretty famed investor, and he made the case that fixed annuities right now are a great replacement for bonds for three different reasons. They lower the overall risk to the portfolio, they lower the overall fees to the portfolio, and they increase the overall yield or income that the portfolio can produce. And what we are seeing in 2022 as interest rates are rising is that bonds and bond funds and the traditional conservative fixed income side of the portfolio has lost value. So the bond aggregate index is down more than 10% year to date. Well, I don't want to lose 10% of my conservative money, and bonds aren't paying that great of an interest rate. They haven't for quite some time. So where I may get a 4% bond inside of my portfolio that I've got to, wait 10 years for that bond to mature, plus there is an advisory fee of 1 or 1.5%. So I'm actually only netting 2.5 to 3, and then it loses 10% in value. A fixed rate annuity may have a shorter time duration, like 3 or 5 years, be paying 3.5 or 4%. Those interest rates are subject to change, by the way. We get different announcements on what those rates are almost every day, but it may be paying a higher rate for a shorter period of time, and then the fee actually doesn't come out of the individual investor's pocket. They get the net of what that fixed rate is without the risk of loss of principal in a market and interest rate environment like what we are in. So yeah, Erin, I would say that it is a consideration. Now, again, we've got to look at the specifics of what somebody wants to achieve and accomplish. But when you define a goal, you look at all of the tools that are available to achieve that goal, and fixed annuities are certainly in that category.
Okay. So I have one more question for you then. There are also ETFs or mutual funds that can accomplish the same goal and can be a lot cheaper. So how do you help an investor determine what's right for them?
Well, so I would actually disagree with that on a couple fundamental levels. One, that
Okay.
ETFs or mutual funds can accomplish the same goal. ETFs and mutual funds are investments. They have that risk associated with them.
Right.
And I know that there are, some one-off caveat mutual funds and ETFs that you can have buffers against losses or have stop losses in place, but that comes at additional fees oftentimes. So if you're looking at the safe end of the spectrum, like a fixed or a fixed indexed annuity, I would argue that there are not mutual funds or ETFs that can accomplish the same goals at lower costs, because the fixed or fixed indexed annuities generally do not have fees associated with them and are protected against market losses, where ETFs and mutual funds are at risk of market losses and oftentimes have fees or costs associated with them. Now, again, you've got to look at the individual investment. You've got to know the ins and outs of it, if there are riders being included on them, or if there is a surrender charge period where you can't get your money out for a certain period of time. You've got to be aware of that going in. But I find that unfortunately a lot of people's frustrations with annuities just was not knowing all of the features on the front side getting into it, and then they're surprised by them on the backside. If they are clearly explained and the due diligence for education is done ahead of time, annuities can do some certain things that really no other financial vehicle can do, which is protect against longevity and generate a lifetime of income that you never have to worry about outliving, such as Social Security or pensions. Those are actually also forms of either government sponsored and mandated or company offered annuities. And you can have one personally as well. Again, annuities do several things, and you got to know what you're getting into.
And this is why we make these videos, Peter, is to help make sense of all these options. This was really helpful. If somebody has a question about some of these annuities, or again, figuring out what's right for them, what's the best way to reach you?
Yeah, if you are considering an annuity, if you have been told you should get into one, if you want to find out more, weigh all your options, get some education, give us a call at Richon Planning. That's what we are here for. 919-300-5886, 919-300-5886. You can email me, Peter at richonplanning.com. It looks like Rich on Planning. It's my last name, richonplanning.com. And of course, that's where we're at online as well, richonplanning.com.
Perfect. Peter, thank you.
Absolutely. Always a pleasure.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.